If you're part of purchasing, financing, or even contracting an organization, then you always have to think of or explain how you would achieve value for money in a contract. Now, all that is assuming you're in a position to actually analyze how cost and finance can impact on supply chain. What exactly do you know about the financial objectives of an organization you're dealing with? Do you understand the cost of material, labor, and overheads? How about working capital? What do you know about that? What if the organization is undertaking a project? How do they fund that? And finally, do you understand the corporate financial decision? We're going to talk about all that and many more in this video. So the financial objectives of an organization will, for starters, depend on the organization, right? So they vary from one organization to the other, but typically they tend to fall under the following categories: obtaining value for money, maximizing shareholders' wealth, as well as generating surplus. Speaking of value for money, the idea for value for money is actually very popular in public sector organizations, although you can still have these with, say, third sector organizations, things like charitable organizations, community or volunteer. All that. Value for money means the most advantageous price for an organization or customer to spend on a fit for purpose product or service. And of course, given that when we talk about public sector in just about any country, okay? So public sectors organizations tend to have limited resources, or rather limited amount of money. And so it goes without saying that they really need to be serious, okay? They need to be very particular about what they spend money on and what value they get out of that. Public procurement must therefore always be based on value for money. This could be achieved through competition, things like competitive biddings, and that is where tenders come in, right? Unless they have a competing reason to make an exception. Remember, there's a difference between value for money and lowest initial price. In UK, for example, the National Audit Office assesses how much a government spending represents good value for money. Of course, the question then is, how do they do that? Especially since something like value for money is actually hard to quantify. Well, they do this by paying attention to economy, efficiency, and effectiveness. So economy, okay, in this case, has the government minimized the cost of resources used? Has the government spent less? Efficiency, what is the relationship between the output for the goods or service produced and resources spent to procure them? That is, has the government spent well? In terms of effectiveness, what is the relationship between the intended result and the actual result of public spending? So the outcomes, that is, has the government spent wisely? So that is the thing about value for money when it comes to public sector procurement. Of course, you can think about value for money in many ways, but in this case, we're talking about public sector procurement because that is the one place where if you are in charge of procurement, value for money becomes a big deal. It is a big deal in just about any company, but in this case, you're just going way out there and just saying, okay, look, you can do that in your private sector, okay? But in procurement public sector procurement, this is a big deal. Talk about wealth maximization. So think of it this way, okay? We have, whether it's public or private companies, we have shareholders, and shareholders invest in these companies for different reasons. And if one of the reasons why they invest is dividends, then dividends are going to be paid in accordance to the shares they have, okay? So paid to the shareholders in accordance to the shares they have. Maximizing shareholders' wealth is about maximizing the flow of dividends to the shareholder. So a company's value is generally going to be expressed in terms of the value of the shares. So the higher the shares in terms of, worth, okay, the valuable the company. That is one of the ways that a company is going to be valued. Managers make decisions to increase the total market value of the company in the long term. Now, the total value encompasses the value of all the financial claims on the company, including equity, debt, and preference shares. Regarding how a company can actually increase its value. So a company can increase its value through any of the following ways: investing in new projects, maximizing profits from company's existing products and services, adding value to the company through a process, okay, as well as controlling cost. Now, the company's value is reflected in the share price in the short term and in the net asset value and equity per share. Okay, so two things in this case: net asset value and equity per share. So what are those? Net asset value is the company's total asset minus its total liabilities. For example, X Limited has securities and other assets worth $100 million and has liabilities of $10 million. Okay, so the company's net asset value will be $90 million. But think about it this way, okay? Now, because investment in the companies and things of that nature will change daily, so the net asset value of the company is also going to change. All right? So it's not like if that 90 million is pretty much what the company is going to be worth for a very long time. Nope. Those things change with the daily operations of the company or with the, gradual operations of the company given the timeline. Equity per share is a company's equity divided by its total number of shares. Which means if you own 10,000 shares in company Y and the current price per share is 100, you are worth 1 million. And so you see, maximizing the company's shares, okay, the value of the company shares will mean maximizing the shareholders' wealth. From a shareholder's perspective, there are three variables related to returns which directly affect shareholders' wealth. In this case, we're talking about the size and value of cash flow, the timing of cash flow, the level of risk associated with cash flow. But there are other factors, okay? There are other factors that can also make the shares lose value, which means they can make you, your value in a company or how much you've invested in a company to drop. For instance, in April, okay? So in April 20th, 2010, the oil drilling rig, Deepwater Horizon, operating in the Macondo prospect in the Gulf of Mexico, exploded and sank, resulting into the death of 11 workers on the Deepwater Horizon and the largest spill of oil in the history of marine oil drilling operation. 4 million barrels of oil flowed from the damaged Macondo, well over an 87-day period before it was finally capped on 15th July 2010. Now, on December 15, 2010, the United States filed a complaint in a district court against BP Exploration and Production and several other defendants alleged to be responsible for the spill. The BP share price dropped from 600 to 300. That basically means that shareholders' wealth in this company, so the people that bought shares in that company, the value of their shares are just cut by half. So regarding profit maximization versus wealth maximization, there's a huge difference. Okay, there's a huge difference between profit maximization and wealth maximization. Profit maximization refers to how much money the company can make in short term, with the focus on extracting value at the potential expense of tomorrow. Wealth maximization, on the other hand, is a long-term, okay? We are thinking long-term. With wealth maximization, that's the thing. We're looking at it from a bigger picture, okay? So from a long-term perspective. Timing, cash, and risk are the key variable when it comes to wealth maximization. Of course, these are immaterial when immediate profits are the sole consideration. So when investors look at a company with an intention of acquiring shares, in addition to everything we've just said, they also look at things like operating profit, gross profit, net profit, and earning before interest, tax, and depreciation. Now, they also take into account, okay? They also take into account things like profit margins, return on capital, gearing, and other ratios. Okay, but you see, organizations in third sector, okay, things like charitable organization, voluntary community volunteers, and non-governmental or not-for-profit organizations, these ones are not necessarily driven by profit or wealth maximization. These organizations are typically set up to achieve some societal goals. They may need some surplus to remain financially sustainable and to allow investment in their various social, environmental, and cultural objectives. But they will still need, okay, they will still need to reinvest the surplus. So in this organization, profit is actually going to be referred to as surplus. So they'll still need to reinvest surplus in the organization, otherwise they're just going to collapse. So that is something that you also need to remember when you're dealing with such kind of organizations. Now, there are many ways, okay? There are many ways in which you can classify costs in an organization, and we can think of them in terms of, say, fixed and variable costs. Now, with fixed costs, we're talking about the sort of costs that do not change with the level of production, right? The more you produce, it doesn't really matter. So like rent, okay? Now, with variable costs, these are costs that will change with the level of production. The more you produce, the more you incur them, like the cost of raw materials. We also have some costs that are semi-variable. So semi-variable costs have both aspects of fixed and variable elements. For example, workers' payment that is also combined by, say, something like a commission. So the salary part is actually fixed, but then the commission will depend on, well, how much they sell, say, like in case of sales commission. So you see, the commission will vary, but the salary itself will not vary. So fixed, variable, semi-variable. Now, the other way we can classify costs is direct and indirect. So direct costs are, in this case, going to be directly attributed to whatever it is that you're producing. So if you produce cars, the cost associated with making that particular car is going to be direct. Things like, carbon fiber or whatever it is, the leather for the seats. But the people are going to sell that car, okay? The salary you pay them, that is going to be indirect cost because it's not directly attributed to the production of the car. And then there is also third aspect of cost, an opportunity cost. So with opportunity cost, we're talking about the cost you incur by taking a given choice, all right? So for instance, choosing to spend $25 on pizza or drinks means there is no $25 to spend on something else. Let's say an online course, which could have been beneficial to you as opposed to, say, the pizza or the drink. So that becomes the opportunity cost. Now it's important, okay? It's important in the financial world for you to understand the various costs that you're incurring in whatever it is that you're doing. That is important, especially like in the supply chain. When you make one choice, let's go with this company. Now you're spending money on that company. What else could you have done with that money? Supposing you went with another company, how much would you have saved? Things of that nature are important when you're talking about opportunity cost. With cost management, you have a number of things to consider. There is planning, decision making, as well as control. So with planning, in this case, you need to ask yourself a number of questions. Questions like, what impact will a change in production level over a period of time have on costs? What effect will expanding operations by opening a new outlet in a separate location have on cost? What impact will extending opening hours to improve client service have on cost? Now, with decisions, with decision making, you'll be looking at questions like, what is the impact on cost of producing components locally compared to producing components overseas? If demands for service is failing, is it effective to continue to provide that service? With control, you need to think about things like, do product costs match the target set? How closely? Do service provision costs match the budget set? Again, how closely? Okay, so here's the thing. In business, you have things you own, which are called assets. Now, depending on how quick these assets can be turned into money, you have non-current assets and current assets. So basically, non-current assets are things that you can't quickly turn into money, plant, property, equipment, right? You have current assets, things like cash that you're going to receive, money in the bank, things of that nature. But there is the question of how you got these things. I mean, you have a laptop, you have a car, you have a piece of land, all that stuff. How did you get them? And this brings in liability. So liability can be current or non-current. Basically, it can be long-term debt or it can be short-term debt. So, assets, things that you own. Liabilities, how you own those things. So you have a car. How did you own the car? Did you use your own money or did you use a debt to get the car? Where am I going with all these? Working capital, that is where we are going with all these. When we talk about working capital is the capital available to a business used in its day-to-day trading operation. And working capital is calculated as current assets minus current liabilities. So remember, there is the money that you're going to spend on day-to-day aspects, okay? Paying the person who cleans, paying the local authority, things of that nature within your operation, okay? Your business operation cycle. And so that is the reason why they need to be, there need to be money. And that money is going to be the difference between your current assets, cash at hand, cash in the bank, things of that nature, and your current liabilities, the debts that you need to pay within that period. So you can't say, I have land worth 10 million. I mean, yes, you could have land worth 10 million, right? And that doesn't really mean that if somebody wants $100,000, then you'll have to sell that entire land so that you can just chuck out $100,000 to pay that. It doesn't work that way. In this case, you'll probably be interested in having something like cash that I'm expecting to come in this week is probably $200. And this week, I also need to pay $100 dollars or something. Okay, so $200,000 and I'm going to pay $100,000. So in that case, you see, you have working capital, right? You can operate. That is the thing with working capital. That is something you need to understand because that is going to affect how things move within the supply chain. Okay, if you're a supplier or within the supply chain, if you're a buyer, it all comes down to, do you have money to pay for what you want? Do you have money to supply what is needed? Now, the working capital requirement is the financial matrix showing the amount of financial resources needed to cover the cost of the production cycle, operational expenses, and repayment of debts. Logically, the working capital requirements calculation can be done via the following formula. So, working capital requirement is equals to inventory plus accounts receivable minus accounts payable. All right, what do you have plus what you're going to expect minus the things that you need to pay for within that particular operational, the operating cycle, okay, or the production cycle, whichever the case, right? So at this point, there is going to be a PDF summarizing the working capital requirements that you can download, link in the description, okay? You can download in the resource part of this video, just check it out. So there is that, right? So download the PDF, go through, understand the working capital requirements as well as calculations and things of that nature. Obviously, if you have a question, you ask, okay? So don't sit there with your question.